All right, let's get right into it. On January 30th, the precious metals market got absolutely hammered. I mean, it was a brutal, sudden crash that left a lot of people scratching their heads. But the big question is, was that the end of the bull run, or was it something else entirely? Today, we're going to decode the hidden signals from that day to figure out what was really going on under the surface.
So yeah, this is really the whole mystery, isn't it? Did that violent plunge signal the top? Was that the final nail in the coffin for gold and silver? Or, and this is the interesting part, could it have actually been the starting gun for the next massive leg up? You know, the answer isn't what you see on the surface. We have to dig a little deeper.
And to get to the bottom of it, we have to put on our detective hats. Forget the headlines for a second. We're going to do a bit of a forensic analysis on the trading data from that day, because buried inside those numbers is a completely hidden story. And it's a story that doesn't just tell us what happened, it gives us a huge clue about what's probably coming next.
Okay, first things first. To solve this puzzle, you have to understand that we're not talking about one market. We're really talking about two totally separate markets, the paper market and the physical market. And on January 30th, the players in these two worlds behaved in completely opposite ways. That difference, right there, is the key to this whole thing. So let's break this down. It's basically renters versus owners. On one side, you've got the ETF traders. Think funds like GLD and SLV. These folks are essentially renting exposure to the price. They're often speculators, driven by short-term charts and algorithms. Then, on the other side, you have the owners. These are investors in physical trusts, like PSLV and PSLV, which are designed to go out and buy and hold actual physical bars of metal. Their motivation is completely different. They're in it for the long haul. So how do we know what these two groups were actually doing during the chaos? Well, the magic metric here is something called net asset value, or NAV. Just think of NAV as the true underlying worth of all the gold or silver a fund holds at any given moment. Now, normally, a fund's share price should trade right in line with its NAV, but when panic strikes, that link can break. You get these weird discounts or premiums, and that's what tells the real story.
And this brings us to the core evidence of our little investigation. The trading data from that day gives us what I can only call a smoking gun. It shows us, clear as day, exactly who was panicking and who was using that panic to their advantage.
When you look at the paper markets, those ETFs we talked about, the story is crystal clear. It was just pure, unfiltered capitulation. The renters were stampeding for the exits, selling anything and everything as fast as they possibly could.
And this chart just lays it all out. The big paper ETFs, GLD and SLV, saw enormous redemptions. People were yanking their money out, forcing these funds to dump metal onto the market. But here's the real kicker. Their share prices were trading at a constant discount to their NAV. Think about what that means. People were so desperate to get out, they were willing to sell their shares for less than the physical metal they represented was actually worth. That, my friends, is the textbook definition of a panic.
Okay, but here's where the story takes a wild turn. While the paper market was an absolute meltdown, the vehicles that represent actual physical metal were telling a completely different tale. In fact, they were telling the exact opposite story. Just look at this. The physical trusts, FIZ, and PSLV didn't just hold up. Their discounts to NAV completely disappeared. The Silver Trust, PSLV, even flipped to a slight premium by the end of the day. This is so important. While the paper speculators were dumping for cents on the dollar, the so-called smart money, the owners, were stepping in and aggressively buying the dip, paying full price, or even more, to get their hands on the real thing. This wasn't panic selling. This was deliberate accumulation. And believe me, this distinction is everything. In a true, cycle-ending bear market, you see the exact opposite. The physical trusts get crushed, trading at huge discounts because the long-term believers have finally thrown in the towel. That is absolutely not what happened here. The physical funds held the line. This doesn't look like a new bear market. This looks like a classic, violent, but ultimately healthy bull market correction.
So that leads us to the next obvious question, right? If this was just a shakeout, why were the owners, the smart money, so eager to jump in and buy what looked to everyone else like a total collapse? What do they see that the paper traders are missing?
Well, the answer, as it so often does, lies in history, because the behavior we just saw, a huge paper sell-off while physical demand stays rock solid, is a direct echo of one of the most powerful precious metals bull markets we've ever seen, the 1970s.
See, the 70s bull market wasn't just a straight shot up. It happened in two huge waves. First, you had a massive 5x move in gold. But then came what we call the intermission.
A nasty 50% correction that lasted almost 2 years and convinced nearly everyone the party was over. It shook out all the tourists, and only after that did the real move begin, the Mania Phase, an incredible 8.5x explosion higher. That intermission from 1975 feels an awful lot like what we might be going through right now. And the parallels between then and now are just eerie. You've got a similar inflation problem that comes in waves. You've got central banks trapped, trying to stop and start policy. You have rising geopolitical tensions all over the world. And you have a complete collapse in public trust from major institutions. The macro environment today looks just like the setup for that second explosive wave back in the 70s.
But you know, there is one massive difference that makes today's situation potentially even more explosive. And it's this number right here. Today, US debt-to-GDP is over 120%. Back in the 70s, it was only 35%. This one fact changes the entire game.
And here's why that debt number is so critical. Back then, Fed Chair Paul Volcker could famously jack up interest rates to 20% to kill inflation. It was painful, but it worked. Today, that is literally impossible. If the Fed tried to raise rates anywhere near that high, it wouldn't just cause a recession, it would bankrupt the US government. The interest payments on the debt would explode. Simply put, the Fed's hands are tied in a way they just weren't back then.
So, let's put all the pieces together. We've seen the smoking gun data from the crash. We've looked at this incredibly powerful historical parallel from the 1970s. So what does this playbook suggest is coming down the pipe?
Well, if that 1970s analog continues to hold, the path forward looks something like this. Step 1, we're probably in it right now. A volatile, confusing, choppy mess where the mainstream media tells you every day that gold is dead. Step 2 is the trigger. Eventually, something in the financial system breaks, and the Fed is forced to pivot back to printing money to save the bond market. And that pivot is what kicks off Step 3, the Mania Phase. That's when the next major wave up begins, driven by a real loss of faith in paper currencies.
So, when you look at all the evidence, it seems pretty clear. That crash on January 30th wasn't the end of the story. It was a violent shakeout designed to get rid of the paper speculators, the tourists, and the long-term owners used it as a massive buying opportunity. Which really just leaves us with one final thought. If the tourists have been washed out and the 1970s playbook really is in motion, the only question that matters is, are you prepared for what comes next?